What is good, guys, and welcome back to the channel. And today's topic will be a breakdown of my entire 4-step protocol, my discretionary trading system, which I use in the markets and I have refined over the last few years. And I will show you today exactly how this 4-step protocol is built up and will give you the exact breakdown. Before we get into each different part of the 4 steps, I will give you a quick idea what's the purpose, the intention behind those 4 stages. So each stage will act as its own filter of this overall funnel, right? So you have to imagine you start with the first layer, which is trading conditions, and only then once everything that's crucial and that first layer is being met, then you go to the next. And then the same thing here again. You can only progress to the next step, to the next layer in the funnel once this has been confirmed, and then you go to the narrative. Once you're at the narrative, as you probably guessed, only once trading conditions, bias, and narrative are all three aligning, then it actually comes down to execution, which is pressing or deciding if you're going to press the buttons and take a trade or not. And if you follow those 4 steps consistently without skipping any of the layers, then the only outcome is taking high probability trades. All trades which are at the outcome of that funnel, they are all high probability trades. So I would say let's get straight away into the first topic, which is trading conditions. What even means trading conditions? So trading conditions are always relative to your system. For example, in my case, I am trading an expansion after a stop run, meaning if the market is not likely to expand, then that's a low probability for my system, meaning if price is likely to be in a consolidation or range bound, then that's for me low probability. There are also systems out there which might perform really well in consolidations, like mechanical systems, but most discretionary systems, they all rely on expansions, meaning in this case, you want to be able to anticipate how likely are we going to see consolidation or expansion in the following week or in the following day or even in the following sessions. And that's crucial to identify. And for that, we use time and price-based conditions, right? We will start with time-based ones. And the first time-based condition being before major red follow news. So if we have NFP, FOMC, or CPI, the big three, usually before those three, the markets will often consolidate, sometimes even already a day before, but usually the sessions before are always low probability. I'm not saying you can't trade them. There are conditions where you can trade them, but that's a bit more advanced and would now exceed the topic of this video. But as a rule of thumb, especially if you're a beginner, try to avoid around NFP, FOMC, and CPI. Then another time-based reason is if we have multiple red folders in the same session. For example, the day ahead of NFP, we always have in the New York session 3 red folders. And for that, you have to be aware, if we have 3 red folder sessions, there is a high risk of manipulation. So usually one of those 3 news events will be at least a manipulation against your bias, meaning until that manipulation has happened, you don't want to take a trade. Price either in consolidation, seeking destroy, or still in the manipulation phase. As mentioned, day before NFP, FOMC, CPI also oftentimes already tend to be in the consolidation, again, depending on the overall context and where we are trading on the higher time frames. We will come to the price-based conditions in a bit. Then also, Mondays are usually for me low probability. Why? Because I use Monday's daily candle to frame the potential narrative heading into the rest of the week. And since ahead of Monday, we obviously don't have any information, and also we have oftentimes no news on a Monday, I usually want to wait for the Monday daily closure to then give me the narrative, or the potential narrative heading into the rest of the week. The same goes for the monthly candle, usually the first week of the month, where we also have NFP usually. I am taking less trades in the first week of the month, and then my focus is usually in the second, third, heading into the fourth week of the month, using again, same as we use the Monday for the weekly candle, using the first week of the month for the monthly candle narrative. There we come now to the price-based condition. So the first condition is if we are trading or if we have taken out a higher time frame objective, for example, an old weekly high or low. If we take that out in price most likely turns into consolidation profile, and either will continue the trend or it'll reverse after taking out a buy or sell side. But since you don't have that information yet, you're better off to wait and let price do its thing, and then come back once you have those new information. Same applies if the previous days or session have overextended. For example, I have a 3-candle rule. If we have 3 consecutive daily expansion candles, then the fourth day, I'm not looking for a fourth expansion in the same direction. The same applies for sessions. If you see, for example, in New York session, that already London and Asia have both expanded in the same direction, and we met already the average daily range, then obviously you don't want to look for a third expansion in a row in New York session. It doesn't mean it can't happen, but again, you always want to think in probabilities, and it's simply lower probability to see that happening. Then we go to the remaining ones. If price is trapped between 2 opposing PD arrays. What do you mean by that? For example, if we take a look at DXY on the weekly time frame. Here we see here on DXY, we have this bearish OB, we have this bullish PPR, and as you can see, price is on the weekly time frame trapped between those 2 opposing PD arrays. So it's not willing to close above the bearish OB, but at the same time also not below the bullish BPR. So as long as we not either close below down here or above this bearish OB, we are in trapped order flow. If we close below, we can expect a run into that low and potentially even into lower sell side targets. If we close at least above the middle of this bearish OB, we can expect a run of this high. And that's how you can then set your buys for the coming weeks. Back to the list. So then the fourth point is if price is trading around a higher time frame mid-range. So for example, we have a daily dealing range or a weekly dealing range. We have the swing low, we have the swing high, and then price is clearly trading in that range, around mid-range, and then is in a consolidation. That is also low probability, and those consolidations will oftentimes happen around the mid-range of a higher time frame dealing range. So always be aware if price shows signs of consolidation or unwillingness of displacing to either the range highs or range lows, then be aware that this is a low probability condition. Then the next low probability filter is if price is expanding into an opposing PD array without yet reclaiming it. What do I mean by that? So if we have, for example, a bearish value gap, and we are actually bullish, so we're long somewhere down here, then price is approaching a bearish value gap, but yet has not reclaimed it by a closure above, so we can then use it as an inversion level. As long as we don't close above, this will act as resistance, and you don't want to look for longs right below. You either hold your longs from down here, or you look for more longs once you close above and then have inverted this value gap. Next point is if price sweeps both sides of the previous session high and fails to displace beyond. Again, what is that? If we have, for example, Asia session range, Asia high, and the Asia low, then we have London session coming up, and London sweeps the high and the low, but fails to displace beyond. So it closes back inside the range of the Asian range without being able to close or displace either to downside or to upside, and that's usually an indication of a seek and destroy profile, especially if other things of that list are being met. Also, trading conditions are not black and white, right? Meaning sometimes conditions are really high probability, sometimes really low probability, and anything in between. So you always have to, with your experience and your anticipation, have to assess how high probability are they right now, by how many things are currently being given. For example, if only one of those things is being met, it might be not as low probability as if, for example, all of those points are being currently the case. What's also low probability condition is if the daily and order flow are not aligned, meaning, for example, daily we are bullish, and on the hourly we are bearish. Daily is bullish, hourly is bearish. Then we have not the high probability time frame alignment to look for trades. For high probability alignment, we always want to have the hourly time frame, the hourly and the H4, trading in the same direction as the daily order flow. That is the most high probability combination you can find. So always make sure that's given if you really want to only take those A+ trades. You can also trade against the hourly and daily order flow, but again, that is more advanced and you need more experience. Then the second last point, or the third one, is intermarket correlations are not in symmetry. So for that we use DXY, all the majors, and bonds. For example, if T-bonds and DXY are both trading in the same direction, meaning both are bullish, bearish at the same time, then that's not a symmetry you want to see. Another example for intermarket correlations would be between the majors. Euro is bullish, pound is bearish, or consolidating. UJ is bullish, Swissy is bearish. So the symmetry which you always want to see, Euro and pound both being bullish, UJ, Swissy both being bearish, and UCAD, that's high probability. If they're trading all kind of different, decoupled, then that's a low probability. Then the second last point is no clear daily bias. So if you look at a daily chart and you can immediately spot where price wants to go on a daily basis, that is indicating indecisiveness and therefore it's a low probability. The last point is higher time frame order flow not confirming your bias. So if you aim, for example, for an old high, that's your bias, swing high, we hit like a bullish key level down below, but price has not yet shown the signs of displacing higher, meaning price confirms by displacement this being the target. As long as you don't have order flow confirming your objective, it is still just anticipation and low probability. Or lower probability, right? So once you have assessed the trading conditions, then we can go over to the bias, right? So conditions are done. We are trading in high probability conditions. We expect an expansion profile. But the next question is, what is the bias? In what direction do we want to see the expansion to occur? For that, again, we have time and price-based elements. So for the time-based elements, we want to combine lower time frame with higher time frame objectives. For example, weekly and daily highs combined with intraday highs such as the Asia highs or any other session high or low. The question you always want to ask yourself, is the current high or low being engineered to get taken eventually as a stop run, or are we currently in a stop run, meaning a manipulation? Usually you will see price, if you form a dealing range, it's retracing, then initial retracement is the engineering phase. You can also watch my video on liquidity engineering, then we come back one more time, and then there's a stop run where you then want to look for your continuation. So the next thing you want to ask yourself, you want to use the prior month, week, or day, or session high or low as your anchoring points. What do you mean by that? The time-based highs or lows, like monthly, weekly, daily, session, those are the most important time-based liquidity pools, and therefore you always want to be aware of them and see which ones we have not swept in the last few weeks. For example, the last 4 weeks, which previous weekly highs or lows haven't been swept yet. Do you have any monthly highs or lows, daily, week highs or lows, and so on. Also, how you want to think is always, until we have not taken out that higher time frame objective which you're aiming for, each run below a week low is considered a stop run or a continuation into the higher time frame target until we take that one out. Then with the price-based elements. Price-based is, again, weak highs or lows. What are weak highs or lows? That's a weak high, for example, here. And that below is a strong low. Why is it a strong low? Because it has taken the liquidity from a weak low, alright? So weak lows are the ones where liquidity has been engineered. Strong lows are the ones which liquidity has been taken from the weak lows. And you never want to trade those moves, you only want to trade after strong low has taken liquidity from the weak low. Other price-based elements are equal highs or lows, which are high probability draw liquidity, and another high probability draw liquidity are highs and lows close to imbalances. For example, if there's a fair value gap, which we have not traded into yet, and below that fair value gap we have an old weak high being engineered, then that high is a really high probability liquidity pool because we have the imbalance which acts as a magnet and obviously the high itself, and then price most likely will eventually at some point come back and fill that imbalance and run the stops, buy stops above this week high. Also, fourth point, untapped imbalance itself, obviously in combination with a weak high below or a weak low above, makes it even more high probability. As mentioned, once external is taken, as mentioned here, internal oftentimes becomes the most logical next short-term objective. And vice versa, if we take internal and then aim again for external. It's always the same sequence. The last thing what you want to look out for is candles with a flat open. What do I mean by that? Sometimes you can see that we open up a higher time frame candle and we don't form a wick. So we open up and straight away expand, and therefore we have a flat open and no wick to the downside or to the upside. And usually those flat opens will eventually get later on taken out at some point, and you can use them as either a POI to look for shorts, long if it's flat open to the downside, or you can use them as an objective to aim for if you want to long, right? So once you have then determined your bias, you say, okay, I do think tomorrow we will be bullish or bearish. Then you have passed the stage 2 of the funnel, which is the bias, and you head over to narrative. So bias is direction, narrative is now how is price going to move from where I think it will be heading to, from where it is right now. And that's where narrative comes into play to help you map the path to your target, right? Again, we divide into price-based and time-based elements. Price-based, we use the PD arrays and inversion PD arrays to map the direction into the target. Meaning we're going to use price, we have like the buy side, we have the sell side, we have the buy side, and then with the reversal, we want to use the inversion levels from the former sell side. Once we get above, they will act as support. We have the different stages, reaccumulation, low risk buy, and so on. That's how we can overall create a high probability narrative, how is price going to move, and then we can position ourselves within those different moves until we hit that higher time frame objective. So price always has the same sequence, right? We want to see a manipulation into our PD array, and then we want to see expansion into the door. So we need always a key level and a manipulation, and that sets the framework to look for a trade. Continuation is then confirmed by displacement and opposing PD arrays failing. What does that mean? If we have, for example, a bullish order flow, we want to see bearish PD arrays to fail and then get inverted like here, and vice versa for the bearish case. As mentioned, those levels then become inversion levels once you close above. You always want to wait for the closure and always on the same time frame. With an H4 PD array, you need an H4 closure and not an hourly closure. Then once that happens, they are inversion levels and can be used as a key level to distribute higher or lower from there. Also, how do you determine what are the high probability PD arrays? You always want to watch out for if price used that level previously on the sell side to expand lower. When it's a bearish case, then you would use the buy side to expand higher. And then you want to watch that level once we come back on the opposing side of the range, if then price can finally invert that level. And within those different stages here, market maker buy model, right? We have obviously reversal, then have low risk buy, then we have reaccumulation, and then expansion. And within those different stages here, you have lower time frame AMDs. You have an AMD here, you have an AMD here, and then you want to align those with that high time frame market maker sell model or buy model. Meaning accumulation, then manipulation into the PD array, and then you want to look for displacement if you want to look for a lower time frame confirmation, and then distribution, right? Then what are the time-based elements? We have the Monday range and session profiles. For both of that, you can find videos on my YouTube channel. Also, as the bootcamp is launching in Q4, the waitlist for the signups is live since today, which has gotten over 60% of all previous participants funded within the following months after finishing the bootcamp. 8 weeks, we will explain everything like here. We will help you to create your own trading plan We will have a professional trading performance coach on board, which will host a weekly mastery session on mindset. We have journaling templates. We will create your own playbook. You have bi-weekly case study streams, daily outlooks. We will take a look at all your trades taken and give you feedback. And if you want to be part of that bootcamp, sign up with the waiting list down below. And inside the waiting list, you will also find exclusive free stuff like my New York session playbook, where I explain you exactly how I trade New York session, what I want to look out for. And also there will be something else dropping for you guys for absolutely free inside this waiting list. So make sure to sign up for that one with the link down below. Then what else is time-based? If there's no clear path between the price and the target. So you say, okay, I have a bias, I think price will go there, but I don't know how because price is for some reason not trading in a clear manner, then that is also low probability. If price is chopping around without accumulation and distribution, right? So for example, we usually want to see price being in a range, then a manipulation, and then expansion. If price is just doing the opposite, it's just consolidating, faking out the range highs, range lows, but doesn't trade in a clean way, then just sit out. And it's again here what we talked about, the Asian high or low. If price fails to break above or below a range, then it is low probability. The same as if we have multiple competing narratives. For example, you can frame a narrative for bullish and bearish, which sometimes can happen. But then the key is to just sit out and not force any side of the market. Just do nothing, all right? Second last point is if price invalidates your higher time frame key level. So for example, here you have the key level, and once price retraces, then we have like news or price gives no reaction and we close back below, then it's invalidating your idea, and you should then sit out and wait until a new bias forms, all right? You should not then try to force trades, force longs or force shorts into the opposing side direction against the bias. That is usually not ending well. Then we now go to the last, final step, which is the execution. So execution is, as mentioned, you only execute when step one, conditions, bias, and narrative are all free aligning, and then execution is the last step. That's why I always preach execution is the least important thing, because if you have done those three things correctly, execution will become so easy. It's the most simple thing. So entry model is always the same. You want a lower time frame stop run and then displacement. So retest of then an inversion fair value gap order block as an entry, invalidation at a recent higher time frame strong, high or low if you chose to enter on a turtle soup entry, or if you use a lower time frame confirmation, then obviously the lower time frame strong, high or low becomes the invalidation. Intermarket again must align, so you don't want to see at your entry time frame suddenly DXY and majors or bonds doing exactly the opposite of what they are supposed to do. That would be again low probability. You can only scale or pyramid into your trade if the initial entry of your trade is being modified. If it's still at the same level, you can't pyramid or scale in. Then TP at liquidity pools and you leave runners for the higher time frame doll. Then the low probability filters for entries is if you force entries at your key level, you don't have yet either a higher time frame validation or you don't have a lower time frame confirmation. Same thing is if we have a weak displacement, for example, price is not really displacing, we just grind higher slowly and there's not really any displacement visible, or price is immediately retracing, for example, like here, we run the range high and then retrace, that is a low probability scenario. Same with choppy PD array. So for example, if we tap the key level, we obviously want to see immediate feedback in price. If price taps the key level and just chops around there, then that's usually an indication that it is a low probability condition as well. Also, you want to avoid if you, for example, have a trade set up, but the valid stop placement, so meaning where your idea would be invalidated, is too big, offering you a decent risk reward, then you're better off to skip that setup because then the risk reward is simply not worth taking it. So first of all, you need to know what risk reward do I need according to my win rate so that I am profitable trading over the long term, and then avoid all the setups which are below that needed risk reward, right? Also, oftentimes around news, you always want to wait for closure, especially around news, right? If we, for example, have a change in order flow level, like a PD array, which you want to see price closing through, Then we have news, the week's already through, but then before we close, it's retracing the entire expansion. Then that's a fake displacement and a manipulation, and that's why you always want to wait for closure when it comes to change in order flow. Another common thing is if the target already has been hit on the higher time frames and people still chase entries. Where do you want to aim for if price already took out the target? Right? Makes no sense. So if price has hit the target and you couldn't get an entry, then just accept that you missed a move and move on with your life. That is pretty much the entire 4-step protocol. It's quite a lot of stuff to go over. But yeah, as mentioned, we will cover all of that, each of those topics in detail in the 8-week bootcamp. Also, we have other stuff like standard deviations, trade management, pyramiding, how to journal, refine your system, prop firm strategies, how to scale your accounts, and so on. All of that will be inside the bootcamp. And yeah, if you want to sign up for the waiting list, there will be only 200 spots in total for the bootcamp. So if you want to have a guaranteed spot, then make sure to get on the waiting list. And then once the sign-ups go live, you will be the first one to get notified with available spots. I wish you guys a great Sunday, and then talk to you all again next week.